Welcome to our deep dive on retirement rollovers and the costly tax traps that can wipe out years of gains. First, we will set the stage for why mixing retirement money can create a massive tax liability. Next, we will identify the most common danger points: DIY rollovers, indirect 60-day rollovers with withholding, and the IRS Pro-Rata Rule. Then, we will show you the safer alternative: trustee-to-trustee transfers, and the reverse rollover strategy that enables clean backdoor Roth conversions. Finally, we will wrap up with steps, timelines, and forms so you can act with confidence. Before we begin, this presentation is for educational purposes only. It is not tax, legal, or investment advice. Individual circumstances vary. Therefore, you should consult a qualified tax professional and your plan administrator before making any rollover, conversion, or transfer decisions. Here is our roadmap. First, we will break down how DIY rollovers trigger the 60-day trap and mandatory withholding. Next, we will address the broker barrier and how to insist on trustee-to-trustee transfers. Then, we will explain the Pro-Rata Rule that complicates backdoor Roth conversions. After that, we will detail the reverse rollover step by step. Finally, we will cover deadlines, forms, and test your understanding with a short quiz. At a high level, moving a former employer 401k into a traditional IRA seems straightforward, but it can create tax landmines. Specifically, if you intend to add non-deductible IRA contributions or attempt backdoor Roth conversions, mixing pre-tax and after-tax dollars in an IRA invites the Pro-Rata Rule, which makes conversions taxable. Therefore, sequencing and account structure are crucial. Let's unpack why DIY rollovers are dangerous. If your broker sends your money to your bank first, you have initiated an indirect rollover, which starts a strict 60-day redeposit clock. Additionally, the sending custodian often withholds 20% for federal taxes. To avoid tax, you must redeposit the full gross amount within 60 days, including the withheld portion from your own cash. Otherwise, the IRS treats the shortfall as a taxable distribution and, if applicable, an early withdrawal subject to penalties. Therefore, the safer path is a trustee-to-trustee transfer directly between custodians to avoid withholding and the 60-day window. Here is a side-by-side view. With a direct trustee-to-trustee transfer, the funds move directly between custodians. There is no 60-day clock, no mandatory 20% withholding, and the paper trail is cleaner. In contrast, with an indirect rollover, the funds are paid to you, land in your bank, start the 60-day clock, and usually incur 20% withholding. If you cannot replace the withheld amount and redeposit the full gross sum within 60 days, the IRS treats the shortfall as a taxable distribution, potentially with penalties. Therefore, the direct method is generally safer. This flowchart begins with the question of whether you need to move a 401k or IRA. If you choose a direct trustee-to-trustee transfer, you avoid the 60-day rule and the mandatory 20% withholding, resulting in a clean transfer. If instead the funds are sent to your bank, you face automatic withholding and a strict 60-day redeposit of the full gross amount. If you meet that requirement, you avoid tax. If you do not, the shortfall becomes a taxable distribution with potential penalties. Additionally, note the warning that if a broker forces liquidation and sends a check made out to you, that is an indirect rollover risk. When you encounter the broker barrier, insist on a trustee-to-trustee transfer that is payable to the receiving custodian, not to you. If a check is necessary, it should be made out to the new plan or custodian for the benefit of you, rather than made out to you personally. If your broker refuses to facilitate a clean direct transfer, escalate or select a platform that supports complex rollover situations. Additionally, verify the receiving plan's details in advance, including account number, mailing instructions, and whether it accepts incoming roll-ins. Now let's discuss the Pro-Rata Rule. When you convert any amount from a traditional IRA to a Roth IRA, the IRS taxes the conversion in proportion to how much of your total IRA balance is pre-tax versus after-tax. The crucial date is December 31st. To keep a backdoor Roth conversion tax efficient, your pre-tax traditional and SEP IRA balances should be zero on that date. Therefore, your goal is to isolate and remove pre-tax dollars from IRAs before year-end so that only your non-deductible basis remains for conversion. This pie chart illustrates a simplified example where 80% of your IRA total is pre-tax and 20% is after-tax basis. If you convert funds while this mix exists on December 31st, approximately 80% of the conversion would be taxable due to the Pro-Rata Rule. Consequently, leaving pre-tax balances in IRAs at year-end undermines the Backdoor Roth strategy. Here is the reverse rollover process. First, confirm your current employer plan accepts roll-ins of pre-tax IRA money. Next, determine the pre-tax amount in your traditional IRA, including any earnings. Then, initiate a trustee-to-trustee transfer of that pre-tax portion into your 401k. After that, leave only the after-tax, non-deductible contribution in the IRA. Next, execute the Backdoor Roth by converting that after-tax amount to your Roth IRA. Then, file IRS Form 8606 to report your non-deductible basis and the conversion, and retain Form 5498 from your custodians for evidence. Additionally, ensure that your pre-tax IRA balance is zero on December 31st. Finally, keep all statements and confirmations for your records and for your tax preparer. This table highlights the critical logistics. For indirect rollovers, the 60-day rule requires redepositing the full gross amount within the window. Missing it makes the shortfall taxable and potentially penalized. Mandatory 20% withholding often applies to indirect rollovers at distribution, and you must replace that withheld amount to avoid taxation of the shortfall. For backdoor Roths, ensure your pre-tax traditional and SEP IRA balance is zero on December 31st. File Form 8606 to report basis and conversions. Retain Form 5498 from custodians as evidence of contributions and rollovers, and reconcile these with Form 1099-R. Question: if your broker sends your retirement funds to your bank account first, what have you likely initiated? Option A: a trustee-to-trustee transfer with no withholding. Option B: an indirect rollover with a 60-day redeposit window and possible 20% withholding. Option C: a tax-free conversion to Roth without paperwork. Option D: a direct transfer that avoids all deadlines. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. When funds are sent to your bank account, that is an indirect rollover that starts a 60-day redeposit clock and commonly triggers 20% withholding. This creates a shortfall problem unless you replace the withheld amount from other funds. Question: to keep a backdoor Roth conversion tax efficient for high earners, what must be true on December 31st? Option A: your Roth IRA balance must be zero. Option B: your traditional and SEP IRA pre-tax balance must be zero. Option C: you must have contributed the maximum to your 401k. Option D: you must convert at least $6,500 to Roth. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. To keep a backdoor Roth conversion tax efficient, your pre-tax balances in traditional and SEP IRAs should be zero on December 31st. This prevents the Pro-Rata Rule from making your conversion taxable. Here are the key takeaways. First, prioritize tax structure ahead of any short-term transfer incentives. Next, keep accounts segregated to avoid mixing pre-tax and after-tax dollars. Then, prefer trustee-to-trustee transfers to avoid indirect rollover pitfalls and withholding. Finally, master the reverse rollover to eliminate the Pro-Rata Rule's impact on your backdoor Roth conversions. To summarize, insist on direct trustee-to-trustee transfers to avoid the 60-day trap and mandatory withholding. If your broker refuses, escalate or move to a platform that supports clean transfers. Neutralize the Pro-Rata Rule by rolling pre-tax IRA funds into your 401k before December 31st. Only then execute your backdoor Roth conversion. Finally, keep thorough documentation and file the appropriate forms, including 8606 and 5498, and reconcile your 1099-R. Thanks for watching. If this helped you avoid a tax trap, please like the video, share it with someone making a rollover, and subscribe for more practical strategies. In addition, post your questions and experiences in the comments so we can learn together.